Welcome back to Investing Talk Podcast. Today, we're tackling a question that's definitely been popping up a lot. Is Lithium Americas a good time to buy right now? We've gathered insights from, well, quite a few sources, analyst reports, company filings, market data to bring you a comprehensive look. Our goal here is really to help you cut through the noise and understand what truly matters about this potential investment. And before we jump into all the fascinating details, if you find these discussions valuable, please do consider subscribing, liking, maybe leaving a comment. Your support honestly helps us bring more of these analyses to you. Oh, and if you'd like us to look into a specific company down the road, just drop it in the comments below. We do read those. Okay, let's get started. Lithium Americas. To really understand it, we need to look at its core, right? What's the main focus and why all the attention?
Right. What's really interesting here is that Lithium Americas is primarily centered around one huge asset, the Thacker Pass project. And this isn't just, any old lithium source. It's actually one of the largest known lithium resources in the world. Once it gets going, it's expected to be the first major clay-based lithium project here in the U.S.
Clay-based, okay. That sounds significant.
It is, technologically and strategically. Now, the company owns a big chunk, 62% of Thacker Pass. General Motors holds the other 38%.
GM. That's a serious partner.
Absolutely. Provides strong strategic backing. But, and this is crucial, the project is still years away from really producing anything significant. Commercial operations are currently targeted for 2028.
2028. Okay, so quite a ways off. That gives us the future picture. But what about right now? What do the financials look like today?
Yeah, and that raises the key question for investors, doesn't it? How do you value a company that's basically still building its main thing? Right now, Lithium Americas has no revenue, literally zero, on a trailing 12-month basis.
Zero revenue. Wow.
So as you'd expect, net income is negative. We're looking at a loss of about $47 million TTM and an EPS around negative $0.22. You just don't expect positive cost flow or profits until 2028, assuming that target holds.
So those standard debt metrics, cash flow analysis, they don't really work here.
Not in the traditional sense, no. Given their pre-revenue and had this massive project underway, they're likely, heavily reliant on external financing. And they face some pretty significant capital expenditures moving forward.
Okay, that makes sense. So if there's no revenue, no earnings, what does that mean for things like PE ratios, price to sales? How do analysts even start?
Exactly. Those ratios are simply not meaningful or available. You can't calculate them. It really highlights that you're valuing potential, not current performance.
So how do analysts put a value on this potential? What's the consensus looking like?
Well, the current analyst consensus is actually a hold. The median price target seems to be hovering somewhere between, say, $3.88 and $4. Morningstar gives it a fair value estimate of $4.60, and they even list a five-star price, their buy price, essentially at $5.91. So that suggests some potential upside from current levels.
$5.91. But I imagine there's a catch with valuing something so far out.
There definitely is, and Morningstar is very clear about it. They assign a very high uncertainty rating to these valuations.
Very high uncertainty.
Yeah, flags significant forecasting risk. Think about discounted cash flow models, another tool we often use.
They wouldn't work either, right? No cash flows to discount.
Precisely. There are no current cash flows. So analysts are working heavily with projections, assumptions about future lithium prices, construction costs, timelines. It's inherently speculative.
Okay, let's pivot a bit from the fundamentals and future potential to how the stock itself is acting. What are the technicals telling us?
Sure. So Lithium Americas is trading recently around the $2.68 to $2.85 range, and it's shown quite a bit of volatility over the past year. The 52-week range is pretty wide, $2.02 on the low end, up to $5.20 on the high end.
Quite a swing. What about moving averages?
Looking at those, the 50-day simple moving average is around $2.79. The longer-term 200-day SMA is about $3.06. Since the price is currently below both, it generally suggests, a mild downtrend or maybe just consolidation phase where it's finding its footing.
And momentum indicators like RSI?
The 14-day RSI is sitting around 55.94. That's pretty neutral territory, not indicating it's overbought nor oversold, just kind of in the middle. Volatility over the last 30 days is moderate, around 2.77%. We saw about 53% green days last month, which is slightly positive, but not really a strong bullish signal.
And the broader market mood, fear and greed index?
That's currently at 39, which falls into the fear category. That generally lines up with the cautious sentiment we're seeing around the stock.
Okay, so technicals are a bit mixed, maybe leaning cautious. What about the overall market buzz or lack thereof, analyst opinions beyond just the price target?
Well, as I mentioned, the consensus is firmly hold. About two-thirds of analysts covering and say hold.
Only about 17% buy.
Yeah, roughly 17% buy, and the rest are neutral. We haven't seen any recent big upgrades or downgrades either. Things seem pretty stable on that front. Also, there's no significant insider buying or selling reported recently, nor is there a huge amount of social media chatter driving things. So the overall sentiment feels, I'd say, neutral to maybe slightly negative. And that really comes back to the lack of revenue, the development risks, and that macro uncertainty around lithium itself.
That makes sense. For a company like this, then, future catalysts become incredibly important. What should investors be watching for, short-term and long-term?
Absolutely critical. In the short term, the next earnings report is one thing to watch that's scheduled around August 12, 2025, but probably more importantly, any operational updates. News on Thacker Pass construction, hitting milestones, staying on budget, or maybe new partnerships forming, those could move the needle.
And long-term, it's all about Thacker Pass starting up.
That's the big one, yes. Commencement of production, targeted for 2028, is the primary long-term catalyst. Beyond that, you're looking at broader trends, lithium market prices, driven by EV demand, battery tech developments, and potentially U.S. government policies. Anything supporting domestic lithium production could be a tailwind.
Okay, we've touched on this throughout, but let's really focus on the risks. Given its pre-revenue, years from production, what are the key dangers potential investors need to be keenly aware of?
Yeah, understanding the risks is absolutely paramount here. It's highly speculative. So first, stock-specific risks. The big one is just being pre-revenue until 2028, assuming that date holds. That's a long time with no income. Then there's execution risk. Huge projects like Thacker Pass can face delays, cost overruns. That's almost expected to some degree.
And funding. They'll need more money, presumably.
Very likely. Funding risk is real. They'll probably need additional capital raises before production starts, which could dilute existing shareholders. GM's stake, while a positive in some ways, could also impact control or how returns are structured. And of course, lithium prices themselves are volatile. That's a commodity risk.
Okay, those are company-specific. What about broader risks?
Good point. Sector and macro risks are definitely at play. What if global lithium production ramps up faster than demand? You could see oversupply pressuring prices. Or what if there's a breakthrough in battery technology that uses less lithium, or none at all? That's a technological risk. And just general economic conditions, a recession could slow down EV adoption, impacting overall lithium demand.
And finally, what about just trading the stock itself? Liquidity, volatility.
Liquidity seems okay. Trading volumes are decent, millions of shares daily, but volatility is high. The stock's beta is 1.54. That means, statistically, it tends to move about 54% more than the overall market, both up and down, so expect bigger swings.
So, quite a minefield of risks to navigate.
Yeah.
Okay, let's try to bring this all together. After weighing the potential against all those risks, what's the bottom line for someone listening right now, wondering if they should buy Lithium Americas?
All right, so summarizing our view, we'd rate Lithium Americas a 4 out of 10.
4 out of 10. Okay, so definitely on the lower end.
Yes, it's a highly speculative play. There is significant long-term upside potential, but that if is doing a lot of work. If Thacker Pass gets built successfully, on time, on budget, and if lithium prices cooperate. Lots of ifs. The current lack of revenue, the negative earnings, the very high uncertainty around execution and funding, it makes it very risky, especially in the short to medium term. That hold consensus from analysts really captures this uncertainty. It's just not a fit for conservative investors or anyone needing stable income or near-term gains.
But for someone with a higher risk tolerance and a long time horizon.
For that specific type of investor, yes. Someone willing to potentially wait until 2028 or beyond, the best entry range might be somewhere between, say, $2.50 and $3. That's below the main moving averages, near recent lows, offering maybe a slightly better risk-reward entry point. Buying around current levels, $2.70 to $2.85. It could be acceptable, but only if you have that high-risk appetite and truly understand the speculative nature.
So definitely not for short-term trading.
No, definitely not. Too volatile, and no obvious near-term catalyst to reliably trade around. For long-term holders, it really should only be considered as a small part of a well-diversified portfolio. You have to be prepared for the possibility of losing a significant portion of that investment. If you do decide to jump in, maybe consider an optional stop loss, perhaps around $2.35 to $2.50, just below those recent support levels to limit potential downside.
And on the upside, take profit levels.
You could think about scaling out, maybe taking some profits if it reaches that $4 to $4.60 range, aligning with those analyst targets and Morningstar's fair value. Or If things go really well with FAC or pass updates and market sentiment turns very bullish, maybe aim higher, like $5 or more, but that requires things to go right.
So ultimately, Lithium Americas is a high-risk, high-reward venture. It's a bet on the lithium future, and maybe even more so, a bet on the company's ability to execute this massive, complex project. No current earnings, no real revenue to fall back on. As you think about all this, maybe consider this. How do you approach balancing these kinds of long-shot, speculative plays, the potential home runs years down the road, with the more steady, perhaps less exciting core holdings in your own portfolio? Finding that right balance is key. Thank you for tuning in to Investing Talk podcast. We hope this discussion on Lithium Americas gives you some clarity. We'll be back soon with another analysis.